So I get it. You need insurance, you're trying to get to your job, you're just not making what you want to make currently, and so it's a little bit more of a struggle to financially afford the insurance costs. Well, we're going to go over that today, and I'm going to help you understand when you have a low income, what type of coverage options you have, and what are the ways that you can save money, not necessarily just find a low insurance company in your state. What I'm going to go over today is what someone with low income can do to lower their insurance costs. We're going to start off with a couple different things. So the first piece that we're going to dive into is several ways that you can lower your insurance cost without affecting your coverage. So if you're like me, you like to have as much coverage as you can because just who knows. We want to make sure that we are getting the best coverage we can, but we also have to afford it as well. And directly after that, we're going to go into the pieces that you can change on your policy. So if you have to make changes and you just need to get that monthly bill down, we're going to dive into those right now. Several of you have donated cups of coffee to me. I do appreciate it on this channel. That helps drive everything. It gives me a little bit more money to buy some more coffee. I'm actually drinking tea with honey in it. As you can notice, my throat is going out. I am not feeling the best, but I'm going to keep making these videos until I can't talk. Okay, so there are some states like California, New Jersey, and Hawaii, and I believe there's one other one that does offer income-based insurance. And it's not what you think it is. It's not even as good as you think it is because it's, in my opinion, horrible. Hawaii is the one I don't really think is really in this category because you have to be 65 years or older and you have to be disabled, which is 34% of the 2006 poverty line. So there's really a low qualification for that one. So if you're young and you're in Hawaii, sorry, you're not going to get that, but follow the next tips that we're going to dive into. New Jersey, I actually sold one about 8 years ago. I sold one of these policies and I got in a lot of trouble for doing it because I did it completely wrong. Some companies don't even train you how to do this because it's not something they like to do, and I see why. So in New Jersey, they allow you to carry just the bare bones minimum. They allow you to remove the full coverage and the property damage and all of these different pieces, but keep the legal liability limits where if you or a spouse got injured, you would have at least the medical piece that the state requires. It's usually like $375 total, but most companies will make you pay it in full because they want to make it difficult. They even might make you email a different department, and that department will have to reach back out to you and then quote you and then email you, and then you have to buy it. It's a pain. And it's a pain for a reason because it really doesn't benefit much of anybody unless you absolutely have no other option. That's just a piece that you can go towards. So for California, to qualify, you have to own a vehicle worth $25,000 or less. You have to be at least 16 years of age and earn less than $32,200 at the time of this video. And for a single person in a household, if there's two people in the household, the income can't go over to $43,550. Now, what they're going to do is that's going to remove your comprehensive and collision, and so you're kind of hurting yourself there if you need full coverage. I believe they're also removing all of the coverages down to basically bare minimums. So if you do get an accident, and if the state is still the coverage I thought it was, which I believe is $10,000 per person is the bodily injury, and I believe you can go as low as $5,000 or $10,000 property damage, and I believe you can even remove the property damage in California, which is just ridiculous. You hit a motorcycle, you hit a tiny little bicycle that is a $400 bike, you have to out-pocket $400 to pay for that bike. It's not worth it unless you have no other option. That's the route you would take. So with the state being an average about $1,600 to $1,700 a year for car insurance, I get it. We need to remove some things or make some changes. So here are the things that I came up with and some things that I've researched that will help you. There are companies out there that allow you to do what's called a low mileage discount. Not just the discount. Some companies do a pay per mile deal where you can actually only drive a certain amount of miles, and then if you go over it, you pay extra. So you can pay a base, and then anything above that base, you're per mile, just like you would do if you leased a vehicle. That's a really good option if you're not going to drive much. Even if you do and you're willing to cut back just to save that income, then that might be the route you go. If it's for work and you're going to drive more than 8,000 miles a year, then I probably wouldn't even look into that program. It's usually designed for vehicles that are secondary vehicles that aren't being driven very often, or people that are either retired or just not driving much, and those are some good options. The second way that you can do this is to check with multiple companies. The company that you're with now, they might be high or more expensive because they aren't a fit for you. Your profile isn't what they're looking for. So I would recommend checking with different options. Each state's different. The Allstate in Michigan is different than the Allstate in New York. So those two companies could have opposing prices depending on what state you're in. Now remember, we said the average was $1,600 to $1,700. It's actually $1,674 per year for car insurance. I believe that's for full coverage, but if you're in Michigan, that's like cheap. You would buy that in a heartbeat. It's ridiculous to get that price here. But if you're in North Carolina or California or Arizona, that price might actually seem high. So it really depends. You got to remember, that's the average. 50% of us think that's cheap and 50% of us think that's expensive. So you've got to determine what your area is best for. I do have a video that I'll link up here if you are going to shop around. There is companies, and the best way to do it is to go by reviews and read the reviews, and I'm going to teach you guys how to look through the reviews to find out whether a company's a good fit for you. If you want to skip all that, I also can put a link below where you can shop with multiple companies. There's an app you can download that will allow you to shop. Also, if you want to do a live quote with people I work with, I'll put that link in there as well. So by getting multiple quotes from multiple companies, you're going to find that you might have the best deal, or you may be paying twice as much as you should. There's no way to find out unless you check. That's why I recommend those links, just because it's usually only one person or one app, and you're not going to get 500 phone calls from 500 different places. It's just a hassle-free way to do it. I find that people that go online and search and they get caught up in these pretend quotes, they end up being tossed around, and before they know it, they're getting 13, 14 different phone calls. So other companies do offer accident free if it's 3 to 5 years. Those are the 2 points at where those are the discounts. So some companies, if you've been 3 years free, accident free, you're going to get a discount. With Geico, if you're accident free for up to 5 years, you can have as much as a 22% discount. And that falls true to most companies. They're going to give you somewhere between a 10 to 22%, 23% off discount if you've been accident free for 3 to 5 years. It never hurts to check with your current insurance, even if that's the one you're going to stay with, to see if that is an option. It's not something you typically have to have them turn on, so I wouldn't worry about whether you have it or not, because it just automatically kicks in based on the time frame. If you're on a renewal, you may not see it till the next renewal, so that might be the reason that when you are shopping that you're getting lower rates, is because you're still in the middle of a term and it hasn't kicked in until the next term. A fourth way that you can do it is to allow the company that you're with or going with to collect data from you on your driving habits. They call these telematics, and you can see them with the State Farm's Drive Safe and Save, Geico Snapshot. You've got all these different names for them, but there's a ton of different ways, and almost every single company offers it. I know it's really a determination of whether you want to give your privacy out or not. And there are some companies I would lean away from, because some companies require you constantly have it in the vehicle for the life of the policy. To me, that's a no deal. And other companies, like I've reviewed on this channel, I'll link some of those here, allow you to do it without having long term. So you can do it for 2 weeks or 3 weeks, and then that's it. You've gotten the discount and you're good. The only thing you have to be careful with those is some companies do the opposite. So if you show that you're a worse driver, they're gonna charge you more. Most don't anymore because they know that's a deterrent. That's a way that people don't want to do it. And so some of them just opt you out. They give you an initial 10% discount to start, and then if you do bad, they just take the 10% away. It doesn't hurt you. It looks like it's a negative because when 3-4 months later you lose that 10%, it's like, oh, they're hurting me. But it's really something that you would have never gotten in the first place. So just keep that in mind. It is worth it if the company isn't going to surcharge you if you do worse. The other part is to add renter's insurance. Well, wait a minute. Why am I adding to the cost when I want to reduce the cost? Well, here's a trick. A lot of people don't understand that having a multi-policy will knock your bill down by almost 20 to 30%. And renter's insurance is so cheap that it's going to cost you less money to have the renters added than it is to have the auto. Now, this isn't for everybody because in some states, the renters is cheap, but the auto is cheap too. So unless you're paying a few $100s a month for car insurance and you're above that $1,600 to $1,700 per month, it's probably not going to be a benefit, minus the fact that you get renter's insurance and liability and property and all that stuff, right? So there's a benefit to the coverage, but for cost wise, if you're paying more than about, let's just say $200 a month or $180 a month, then you may want to look at what the cost of adding a $15 to $20 a month renter's policy would take off on your auto. Let's do the math here. $180 a month times 20% off is $36. Renters is $18. So you're going to save $18 a month by adding a liability coverage and a renter's policy and all of that packaged into one. It's going to be a huge benefit for you. And the final way, as far as I have for not affecting your coverage, is to flip-flop the primary named insured. If you have a significant other or a spouse and the company that you're working with allows you to do this, is to switch who's the primary. You might have to re-quote the whole thing because most programs aren't designed to do this, even though they all do it. It really matters because one of the benefits I'm going to tell you later, and I'm just going to let it out now, is credit plays a huge factor. And it's really called an insurance score. So there's a whole bunch of stuff that insurance checks. It doesn't technically go in and dive in and pull your credit. It looks at history and all that. And it's a whole nother topic. But what that does is if you have worse credit than your spouse or your significant other and you flip it, it might cut 5, 10, 15, 20% off just because the difference between a 580 score and a 640 score is going to be a large amount of money. So there are some other ways that you can cut costs. If this isn't enough and this hasn't helped, we should dive into looking at the type of vehicle you have. That plays a huge factor. I get it, it's a pain in the butt. I've had some family members that do this over and over and over, and it kind of pulls my hair out because you see I'm missing half of it now. But it's because what happens is they make good income, they get these bonuses, and then they buy all this stuff. They got these Xboxes, they're going out to eat more often, there's this, and before you know it, the money's gone. And then something happens where a car breaks down or something happens to their home or they get in an accident and that money is not there anymore. So they have to sell the Xbox, they have to sell the toys, they have to go out to eat less, which is pretty typical. Well, if you're like that, and I'm actually kind of half in that boat myself, I like to buy things as well. And sometimes I overbuy. But if that is you, then you may need to sell the vehicle that you have if it's a higher end vehicle and go with something that doesn't require full coverage. Who's this guy, this rich man on YouTube talking about how you should sell your car and da, 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 da. Guys, I drive a 97 Chevy Malibu. Can I afford a 2020 lease on a Hyundai Genesis or a BMW? I could, right? But one hiccup and I'm screwed. It's more of a matter of financial stability and just kind of planning ahead. I'm saving enough to where I'm not going to have that problem. I've been driving my 95 or 97 Chevy Malibu for about 3 years. And this year I'm probably going to buy a newer vehicle or at least lease something because I am looking and tired of not having air conditioning and hearing my car constantly go, it squeals and it's annoying, but it's part of the driving piece of moving into that position. I'm loving enjoying the process as I get to the level where I want to be. So knocking down the level of a vehicle might be an option to where you're not going to pay hundreds more for full coverage because you have a loan on that vehicle. Little side tip, not everybody wants to drive a 97 Malibu, and I get it. The main reason I got it because it had like 60,000 miles on it 3 years ago. So that 25, 28, whatever the year-old car was pretty much new as far as the engine went, and I was just looking for something strong and stable to get me through until I can afford the one that I really want. But there are some companies out there that will give you loans for vehicles where they don't require that you have full coverage. Keep in mind, that's a high risk, so you could lose out on that because you may still owe the loan and have no car if you have an accident where it was your fault or somebody wasn't covered correctly. So be very, very careful in those situations. In my opinion, if you can't afford to put the full coverage on it, I would lean back and go back to an older vehicle until you're able to get back into that position. If you are on the line of that where you might be able to afford it, then let's look at deductibles. Let's raise those deductibles and put some money in the savings so that if we do have a claim, we can pay part of that deductible or we have access to get it. So let's raise those deductibles from the 200 or the 500 up to 1,000. I usually don't go above 1,500 for collision just because it usually doesn't play a big factor in the cost. Try it, see what your state does, but most likely it won't make any difference. And the last two pieces are very quick, is they don't have a whole lot to do with much. One is your location, makes a huge difference. The territories matter. I don't think moving is necessarily the best choice, but if you're going to move, check the insurance price ahead of time. The last piece is going to be your insurance or credit score. Work on getting that better because that does play a factor in your insurance, and if we can increase that over time and we're going to move our way up into those better coverages again and having the higher income and just really turning around our situation, that's going to make a huge difference. Anyways, guys, I hope this was helpful. I hope it wasn't too long. There was a lot to cover and I'm completely losing my voice. I need my tea. If you guys got value out of this, the thumbs up helps the most. If you really loved it, you can buy me a cup of coffee below. Otherwise, I'm Mark with Think Insurance. I'll see you in the next one.